So good first half.
Absolutely.
Amazing second quarter for a lot of names. Tailwinds are in the rear view. How come?
Well, I think if you look at where we are today, it's hard to argue that things aren't phenomenal, right? I mean, we have the best earnings growth since 2021. You're seeing all these different indicators, like retail sales are double digit. Employment's starting to come back. PMIs are doing really well. So growth is obviously really good, and that's kind of what's been powering the market higher. As we look to the second half, I think the bigger question is, are the growth drivers that drove the first half, are they going to be sustainable into the second half? I think a lot of those are going to be going away. And so it doesn't mean the market can't go up, but there's more risk to that story. And I think it's going to be a little bit choppier.
What are some of those risks to the story?
Right. So, one of the big things is record tax refunds, right? Those are all paid out. And so you get a little bit of a continued boost as those get spent, but that's going away. Part of the big, first half boost was just the fact that we were reopening from the government longest, government shutdown in history last year. You had, the Fed out there doing RMPs and buying treasury bills. You had Fannie and Freddie buying mortgages. And you have AI spending that was, obviously surging. That's continuing, but a lot of these things are going to get a little bit more choppy. And so we look at the second half, and there's probably three big risks that, they don't have to happen, but they're the things that you should be monitoring if you're going to be worried about the second half. The first is the fading consumer tailwinds I already kind of alluded to. The second is AI CapEx vigilantes. You're starting to already see that story play out. And then the third would be just sort of a higher for longer interest rate story as it sort of cycles through the economy. So we think that interest rates more likely to be lower than they were from where we were, and inflation should start to come down as it's peaking. But the fact that they're going to still be elevated, I think, listen, credit card delinquencies are basically, 15-year highs. We have a record amount of credit card debt. There's things that we have to consider as you look to the back half because things have been so good.
The credit card debt and the delinquencies. Yeah. Well, let's start just with the debt. Is that inflation adjusted? So, is that a fair way to compare it?
Well, even if you inflation adjust it, it's high. I mean, if you think about why the consumer has been so good, I mean, it doesn't make any sense. We've had real incomes just went negative for the first time in a while.
Because of inflation.
Because of inflation. So you have these headwinds to consumer, yet spending is really strong. Well, how is that? Well, they're drawing down their spending. We saw basically, if you go back in the 40, 50-year history of savings rates, you don't sustainably come down to these levels where we are today. You did for a few years pre-GFC, but you don't come down here. So they're drawing down to their savings, they're tapping their credit cards, and so that's what's kind of happening here.
Dan, what really is happening is something we've talked about so much, and that's the K-shaped economy. That the consumers that are feeling the pinch or are facing credit card delinquencies, is it the lower rung of that K? And this is the disconnect we get of people not feeling so great, not doing so well in this economy, and then you have a stock market at record highs because there are those folks at the higher income strata, if you will, who are in the market who are doing well.
100%.
And so when does the problem of those that aren't doing so well kind of play out in the economy? Especially when we talk about the wealthier consumer is really what pushes consumer spending.
Yeah, I mean, Carol, you hit the nail on the head. That's absolutely right. And the problem is that the K-shape is getting wider. And we talk about this in the report in our mid-year outlook, but also, probably the bottom part of that K is growing, right? And so the concern is that that lower income consumer that's feeling the pain, it's sort of moves up into the middle income consumer, which becomes a bigger part of the pie, right? And one of the things that's fascinating is that when you look at inflation, we talked about inflation. Actually, if you're in the highest income part of the consumer, you actually have had deflation over the last few years. So not only has your stock market been going up, but actually the prices of stuff you spend your money on have been coming down. Whereas it's this lower income consumer that's felt the most inflation. The interesting thing is the middle income consumer that we talked about, they are just now moving into that inflationary territory. So that's where they start to feel the pain. And that's one of the concerns. Not that it has to play out as a disaster, but we don't.
But when does it matter? I will be honest with you. I think we've had wealth managers on and are like, well, they're not our customers,
Also, they're not the ones driving spending in this country.
Exactly.
That's what they say too.
I'm not trying to be critical, but they're kind of like, well, everybody we're dealing with, they've got lots of money. So I'm like, when does it become a problem in terms of an economy? Certainly it plays out politically.
Well, it's really on the margin, right? I think if you see, like when you look at disposable income I talked about, the real disposable income just went negative.
Yeah.
That's including the wealthy, by the way. So it's like as a whole, the consumer is seeing, and that's not just inflation. Growth for total income is actually slowing, right? So that becomes a bigger headwind for the consumer, especially now that the refunds are paid out. I think that matters today. It doesn't have to be a disaster because the higher income consumer can still spend. But if you think about the starting point, I mentioned credit cards, but pretty much every category outside of mortgages is basically GFC level, delinquencies today.
That's a problem.
Yeah, it is a problem. But to your point, it is concentrated in the lower end. It's the concern is that starts to grow, and not that it's going to collapse things, but on the margin, higher delinquencies and slower growth. That's something that's really not baked into people's expectations.
Can I just ask? But it happens in an inflationary environment, right? Or is it? Or do you anticipate inflation coming down?
Well, so that's the thing is like if inflation, I do think inflation has peaked or is peaking. And a lot of that has to do with sort of the roll through impacts of Iran and oil prices. So as that comes out, inflation is going to come down. The other part of inflation, other thing that's been driving inflation higher is not just Iran, but the economy. We just talked about how great the economy is. People always forget how cyclical inflation is. And so if on the margin things start to slow, not collapse, but start to slow, and oil prices are coming down, you could actually see inflation come down more than people think by the end of the year. I think it's going to be sticky, but it might come down because people are saying inflation is going to stay high. We're pricing in 1 or 2 hikes by the end of the year. We don't think that's going to happen. In fact, if I had to choose, we think base case, no move by the Fed. If I had to choose, I'd say cuts are more likely given what we just talked about.
Yeah.
So then what's the right way to construct a portfolio for what you think this environment will look like?
Well, I think, listen, I'm going to be the 1,000th person that's come on your show this week to say diversification. But diversification matters given what's happening. I mean, you're seeing...
But what type of diversification? Is it asset class diversification? Is it regional diversification? Is it stock size diversification?
Alternative, like where?
Yeah, exactly. At the heart of it, you want sort of factor diversification in the sense that, like, I don't care if you have 1,000 different assets in your portfolio. If they all move just based on AI, that's a problem. That's not diversification. Same thing if they all just move based on oil or interest rates. So that's the type of diversification. But I do think that in order to get that, you need size diversification, you need regional diversification, and I do think that the private markets give you a wider of a menu. I mean, most companies in the world and in this country are private companies, right? So you can either go to the public markets, which are more concentrated than they've ever been, or you actually look to the sort of the private markets and alternatives to look for other alternative sources of diversification.
What should realistically be your exposure in private markets at this point, considering some of the private credit concerns that we've had and still questions about disclosure?
Well, that's what people forget.
Transparency.
That's what people forget is like it's like asking how much should your alternatives exposure be is like asking what should your stocks and bonds total allocation be, right? It should be because basically...
Well, there is a prescription for
64.
based on age.
Yeah.
And also, and 60/40 is classic.
Yeah, it should be based on your risk tolerance. But like, I think what people forget is like, it's not a separate asset class. Equity at the end of the day is equity and debt at the end of the day is debt. So it doesn't matter if it's public or private equity, you're owning shares in companies and if their profits do well.
There's transparency.
The vehicle matters, but like the underlying asset you're buying is still a company, right? Like SpaceX went from being a private company to a public company. At the end of the day, you're an owner, and if SpaceX grows its profits, you're going to benefit from that. And if it doesn't, you're not going to do well. So I think there's benefits. The benefits I see to alternatives are that it's a wider menu that offers more opportunity for diversification because. You talked about private credit, you talked about private equity, but you didn't talk about infrastructure as an example. Infrastructure is very interesting because it's uncorrelated with everything else we talked about, and I think that we're in sort of a structurally higher inflationary environment for the next 10 years, right?
But infrastructure has an AI component. It has an economic component. It's funded by either federal money or municipalities. Like there is a lot.
But this is the opportunity: is that the fiscal budgets can't support the infrastructure you need. That's why the private money is coming in to support the necessary infrastructure. So it is private capital, and there's really good opportunities for income diversification and inflation protection that you're not getting from any of these other asset classes.
So you're not going to say 10%, 30%, 40%. You're not going to say 50%.
I think again, there's a prescription for every person.